Here are 5 stocks, 5 different companies, 5% each, all clearly different tickers. Looks diversified, right? Now watch. What if all 5 are high beta tech names that move together, up together, down together? Then you don't own 5 things. You own one bet wearing 5 costumes. Today I'll show you how I catch that, and a punchline that surprised me. You can be perfectly market neutral and still be making one giant style bet. I'm Sandbox Theory, solo-built hedge-fund-style system, US large-cap equities, paper traded on Alpaca, human confirmation before live orders, and honest that it might not beat an index. Last time we built an earnings drift sleeve. Today isn't a sleeve or an overlay, it's a measurement. It answers a question every book has to face eventually. Is my diversification real, or is it a costume? I'll cover 2 tools, factor exposure and correlation clusters, and then the punchline about being market neutral and still deeply exposed. And I'll be upfront. Right now, this only measures. It doesn't yet stop me. Start with factors. A factor is a style, a common thread that lots of stocks share. Momentum, stocks that have been going up. Value, cheap stocks. Quality, strong, profitable companies. Size, small companies versus large. Each of those styles has an ETF that tracks it. Momentum is MTUM, value is VLUE, quality is QUAL, and for size, I use IWM, the small cap ETF. Here's the tool. I take my book's daily returns and regress them against those factor ETFs. In plain English, I ask statistically, how much does my book move like momentum, like value, like quality, like size? The regression hands back a tilt for each style. But there's a crucial detail, or the answer is garbage. I don't use the raw factor ETFs. I use each factor minus the market. Momentum minus market, value minus market, and so on. Why? Because almost everything is correlated with the market. If I don't strip that out, every factor looks big, just because stocks move with stocks. Subtracting the market leaves the part that's specifically about that style. So what I get is my book's net tilt toward each style, beyond plain market exposure. So the system might come back and say, your book has a big net momentum tilt, meaning strip out the market, and what's left is that you've mostly bet on things that have been going up, 5 different tickers, one shared style. That's the hidden bet the 5-tile picture was hiding. Factors catch the named styles. But some hidden bets don't have a tidy ETF label. They're just a handful of your specific holdings that happen to move in lockstep. So the second tool looks for correlation clusters. Groups of holdings correlated enough with each other that they're effectively one bet wearing several tickers. This is the direct answer to the cold open. If 5 of my positions form one tight cluster, the system flags it. These 5 are trading as one. My diversification across them is an illusion. A single bad day for that theme takes all 5 down together, and my real position size in that idea is much larger than any one tile suggested. Between factor tilts and correlation clusters, I get both angles. Am I secretly betting on a style, and am I secretly concentrated in a cluster of names that move as one? Same disease, 2 diagnostic tests. Here's the part that genuinely reframed how I think about risk. You can hedge your market exposure to 0, build a beautifully market-neutral book, like the beta hedge we covered in episode 8, and still be making one enormous momentum bet. Think about why. The hedge cancels market exposure. Beta. It does nothing about style. If every name I own is a momentum name, then even after I've neutralized the market, the book still rises and falls with the fortunes of the momentum style. Market neutral is not the same as risk neutral. You can zero out one axis and be wildly tilted on another. That's exactly why measuring factors minus the market matters. Market exposure is the loud, obvious risk everyone hedges. Style exposure is the quiet one hiding underneath it, and it can be just as big. The whole point of this measurement layer is to make the quiet risk visible. Now the honesty this deserves. Right now, this is measurement only. The system flags any tilt beyond plus or minus 0.5. It draws a line and says, you've leaned past this on momentum, or wherever the tilt is. But flagging is all it does. It doesn't automatically shrink the position. It doesn't refuse the next correlated trade. It shows me the number and leaves the decision to me. And that's deliberate, not laziness. Turning a measurement into a hard sizing cap, where the system forces the book to stay within factor limits, is a real, separate step, and I want to earn it. I want to watch these flags for a while, see whether they're stable or noisy, understand how often they fire, and whether they'd have helped, before I hand the system power to override my sizing. Automating a bad measurement just lets you be wrong faster. So, see it first, cap it later. On purpose. The regressions themselves are estimates too. They're computed from a window of past returns, and tilts move over time. So I read them as a smoke detector, not a verdict. The factor regressions, momentum, value, quality, and size, each minus the market, and the correlation cluster detection are in the repo, linked below. If market neutral but secretly one momentum bet made you look sideways at your own portfolio, that's the whole idea. A-like helps other people find it. Next episode goes to the deepest question of all, the one that haunts every strategy that made money on paper. Say the book is up. Great, but why? Is it genuine skill, real edge, alpha? Or did I just happen to be long while the market went up, and I'm about to mistake a tailwind for talent? Episode 11. Is it alpha or just luck the market went up? That's the one I've been building toward. See you there.